watching Clorox under pressure, and analyst at D.A. Davidson downgrading the stock, expecting lower sales and perhaps weaker gross margins. Our next guest likes it, though, calls it a value play. Aaron Dunn is the co-head of value equity and portfolio manager of the EV Large Cap Value Fund at Morgan Stanley. Aaron, thanks so much for being with us. Clorox, of course, had big issues, right? Those cyber attacks. And coming out of that, they surprised investors with a better set of quarterly results. Now this analyst is a little bit concerned about that sales growth momentum, winning back shelf space. How do you think about the role Clorox has in the portfolio?
Yeah, I think they had an exceptional period during COVID, right, with sales, and so I think we were already coming off of that before the cyber attacks, and what you're starting to see is an effort by the company to get that shelf space back, and so we tend to take a multi-year view. So in the short term, maybe that slows a touch, but we think longer term, due to innovation and the company's ability to deliver over time, that Clorox is actually extremely interesting here, and especially if you look back at what the company was earning prior to COVID even, we think there's exceptional upside here for a great company, a business that earns great returns, very good balance sheet, and they did have a disruption. We look at things on an opportunistic basis. So for us, the cyber attack and the resulting weakness in Clorox gave us the opportunity to buy a really high quality company. And if you look at it today, on the valuation side, Clorox trades in line with some of its HPC peers. We would argue historically that's been a premium for a reason. They grow more and they have better product innovation. So I would take the other side of that on Clorox.
When you use the word value, I'm still looking at a PE that is more expensive than the market, trading around 30 times forward earnings. Do you have to pay up for defensive characteristics?
I think you do. And I mean, if you look at historically, I mean, all the HPC companies trade expensive relative to the market, and that's because they're generally defensive and earn really good returns. I mean, the market itself, first of all, is not particularly cheap today. So, I think for us to look at Clorox, I think you're on trough earnings. And so we think there's a lot of upside there, and that valuation is going to look a lot more reasonable going forward.
I always talk to you about the growth versus value debate, and certainly 2024 has been a win for those growth investors, carrying the baton, I should say, from last year. How do you think about value? What qualifies as value this year, and what are some factors you think are in place for outperformance?
Yeah, so value for us is not, we are sensitive to the valuation of companies. We look for opportunities and dislocations in the market to find some upside for our clients and create returns in that manner. I think that's just a little different than growth investing, to be quite honest. It's a little more focused on, what's the total addressable market? What is AI going to be in 10 years, for instance? So that's how I look at value. We tend to float towards the higher side of higher quality side of value. So we look for really good companies that earn good returns, maintain good capital discipline on the balance sheet, and earn very good free cash flows. And so when you do that and you focus on companies that have sort of disruption, what you can create is a really high quality portfolio that has a lot of upside from an alpha perspective. Once we do the work to dig in and figure out what the issues are and see where we disagree with the consensus thought out there in the marketplace that's valuing it today. So when we generate a portfolio, that's really what we're looking at. The growth versus value trade this year has been really a continuance of what we saw last year. Our belief has long been that the Fed was not going to be super aggressive in cutting rates. We think that's playing out. What that means, though, is that that duration trade for growth, especially the Big Seven, continues for longer. What I think you're going to see, though, as the year goes on, is a transition of leadership, especially when the Fed does start to cut rates. And I think the economy probably skirts a recession here. And if that's the case, you're going to see value in small cap really start to do much better. And so that's our expectation as the year goes on, although the trend has been the similar things that we saw last year. So frustrating, it takes a little time, but patience is warranted on that.
Okay, so you mentioned maybe trafficking for some ideas in small caps. What's a name that pops into your head that screens well against your criteria?
Yeah, I think so. I mean, we have an excellent small cap team at AV Equity and Morgan Stanley. And so I'll stick the really small caps to that team. But there's a couple of names, I think, on the mid cap level that I could give you. And one is Huntington Ingalls. This is a defense company. They're the largest shipbuilder in the United States. I think spending, and we think spending sort of across the globe for Navy capabilities or blue water capabilities are only going to go up. We're already seeing the conflicts we see in the Red Sea and across Ukraine, et cetera, that the need for Navy spending is going to increase. This is a company that has a backlog that numbers in the tens of billions of dollars, high single-digit free cash flow yield coming off of peak capex, and a lot of modernization capabilities have gone into place to really cut down the time to build these ships. So we like where margins are going. We like where free cash flow is going. Stock looks cheap to us for a very consistent kind of business. So that's one I'll put out there in the more mid-cap range.
I see as well that you have Constellation Brands, which has, I guess, been a great stock for capital preservation over the last 2 years, right? It hasn't gone down. But what gets it kind of moving? I do, a lot of people come on and talk about it as a top idea. What gets it kind of breaking out?
Fantastic question. And you're right, it's been trading in a range. I think there's a couple big pieces of this. One is, first of all, to set the base for that is valuation is cheap, right? So you compare it to its other sort of alcoholic beverage peers. It's trading at a substantial discount to those companies to begin with. And I think that's really what sets the base. The other piece is it's a beer business predominantly with a wine and spirit segment as well. Beer, they're growing share obviously across Modelo Especial, Pacifico, a lot of the Mexican beer brands that are sold in the United States are continue to gain share over domestic. We think that continues. But to get it out of the range here, I think there's two key elements. One is you had a board change. You had a family-controlled company effectively that was on the board. That changed. They collapsed the dual share class structure into a single share class. And so I think we have better corporate governance from that perspective in terms of doing smart acquisitions, doing the right thing with the balance sheet. And once that has occurred, I think we're going to see debt reduction that's kind of coming to the end of that path, and then really share repurchases start to kick in. So there's multiple ways we look at that, and we like the change in the board. We like the change in the governance structure. We think that aligns better shareholder interest with management and the board.